Ladies and gentlemen, welcome back to the Crypto News Podcast. We are buzzing as always. It's cold, guys. I don't know what to tell you. I don't know where you are in this world. My guest and myself today, him being in New York, myself being in Toronto. It's already getting to that point where it's no bueno. I haven't seen the sun in about 2 weeks. I'm dying for some vitamin D, but we battle and we are still coming out with incredible pods, and I can't wait to get into today's. Today we have Nic Roberts-Huntley on the show today, CEO and co-founder of Blueprint Finance, where he is leveraging his unique background spanning medicine, economics, and finance. Guys, he is a former surgeon. 500 episodes on the show. We've never had a surgeon on the show. He practiced at prestigious institutions, including Oxford University Hospitals and the Royal Marsden, then pivoted to finance, doing some TradFi. He was a VP at Point72, a venture architect at Virtual Ventures, and did a bunch of surgical fellowships as well. And now he is at Blueprint Finance. I can't wait to get into this. Nic, absolute pleasure. Welcome to the show, my friend. How you doing this lovely afternoon?
I'm well, thank you. Like you said, a little cold, but we're hanging on in there. Been a good start to the year. No complaints on my side.
I love it. The background. I know that's a little cliche to start. I'm sure you get this a lot, but like I said, 500 episodes of the Crypto News Pod. We've never had a surgeon on the show. If we have, my apologies to whoever that may have been, but I'm pretty darn sure we've never had a surgeon, as this is a crypto pod and not a medical pod. And you weren't just a surgeon at some perhaps crummy institute. You literally worked at some of the best hospitals in the world. Walk me through the career trajectory going from surgeon to TradFi to crypto. Again, I know it's cliche, but that is absolutely wild. I'd love to hear more about that.
Yeah, of course. I mean, look, growing up, I think like a lot of us, very quantitatively and scientifically focused. Medicine was, the kind of holy grail of what to go and study and certainly make your parents proud. I've certainly tumbled a few times since then. And no, I loved what I did. I was super, super fortunate to help people out, look after people. And I think working in the hospital is one of those great places to learn how to work with lots of different people in really complicated under pressure scenarios. And a lot of kind of applied systems thinking about how you approach the human body, how you plan kind of multi-stage operations and all of that good stuff. Kind of fell down the rabbit hole once doing some research around how we could measure how good we were at doing different operations, post-operatively doing large-scale data projects on x-rays. And I kind of fought the university tooth and nail to get a license for a particular type of software out of Europe. Got bitten by the bug on running big scale data projects. Haven't really looked back since. And, without dating myself, that was probably, 15 years ago or so. From there, I kind of went back to school, studied economics and policy at Oxford, did my MBA, and then spent a number of years out in kind of Menlo Park, trying to figure out how to build high performance data systems, financial transaction monitoring platforms, revenue cycle management tooling. Had some success with that and was very fortunate to spend some time after at Point72. Left there because I was extraordinarily bullish on digital assets. I think there was a unique opportunity to build kind of institutional grade infrastructure on how we handle digital assets without taking on too much risk. I think risk is kind of the operative word within crypto these days. And we try and focus on doing sensible things with large volumes of capital consistently, and kind of have had some success over the last, I guess we've been live now for about 13 months, having pushed around about just shy of $40 billion of volume in our first year of operating.
Jeez Louise. Wow, that's wild. Surgeon, TradFi, and we go into crypto. What was it about digital assets, Nic? You said, again, working at Point72, that's an incredible firm. Definitely, again, I'm putting words in your mouth, so I apologize, but definitely didn't need to take the jump and go do this. Was there a particular subset? Was there a specific narrative? What was it that made you go, shit, I gotta get in this arena?
I think I've somewhat been fascinated by markets and kind of market creation for the better part of the last decade after I studied in kind of a graduate capacity. For me, a lot of what digital assets looked like was an era of time where we were finding a net new risk asset that had obvious growth capacity, overlaid with some kind of macro trends that we saw in the early 1980s. I think a lot of my time was spent thinking about what kind of economic picture do we currently have globally? What kind of economic picture do we currently have in the US? East versus West, different regions, different decay functions in different economic markets. Where was an area I thought there would be an unbelievable potential rate of expansion compared to moving into slightly more traditional veins? A lot of the smartest people at the time were drifting into working in digital assets. I think we've seen a lot of those smart people drift across to AI in the last year or so, but certainly starting to see a path to some clarity around how to treat digital assets from a regulatory perspective, but also, I think realistically, the ability to create durable rates of return. It looked a little orthogonal I think people kind of tilted their head at me a bit when I jumped ship into the space,
Yeah.
particularly just after FTX collapse. It was an interesting time to be saying, hey, I'm going to build the infrastructure for institutional grade yield creation, just after we've kind of seen the flagship and the kind of darling of the space collapse. But
Yeah.
seems to have worked out.
I love that. Okay. You just gave me an absolute layup going to the next point. Institutional grade yield creation. That is, I mean, we sort of saw it 2024, 2025. I think BlackRock really kicked it off with their ETF. I don't want to really call that yield generation. That's more just TradFi instruments joining the crypto sphere. But you and I are definitely in the same boat here. There's trillions and trillions, just an absurd, copious amount of money in TradFi that can just be so much more efficiently used in the crypto world. Better yields is sort of front in mind. Walk me through the thesis there. Why is institutional grade yield creation crypto's next major unlock?
Yeah, I mean, you have to set expectations first and foremost. On a relative basis, we're all obsessed with digital assets, right? Like
Yep.
it is the aggregate market cap of Ethereum to us right now, super impressive. Same to a Bitcoin, same to a Solana, XRP, etc. The majors really have appreciated so much in the last 5 to 7 years that we couldn't be happier about it, particularly if you've been holding for that long.
100%.
On an absolute basis, though, digital assets still represent a relatively small percentage of the total investable asset class globally. So when you think about kind of the pie chart of rates of return across investable assets globally, digital assets will continue to remain a small percentage of that for some time. And we've got to ground ourselves in that truth. It's not going to overtake the value of real estate anytime soon, nor will I think it ever. But the question is, on a relative basis, what yield can be generated with a reasonable amount of risk over a sensible amount of time per dollar greater than something in a more illiquid and certainly kind of longer view asset. So we look at liquidity versus rate of return and then duration. I think for me, the most interesting thing is because we've seen such appreciation in the average value of those positions over time, a smaller percentage in terms of rate of return and cash flow is meaningful to its holders. Illustratively, if I put 3% on $1,000 of Bitcoin when Bitcoin is worth $1,000, that's not a meaningful amount of cash flow to me today. But if I now have one Bitcoin at, let's just use round numbers, at $100,000 and I'm generating 3%, that starts to look really interesting.
Yeah.
We've got this interesting friction though, where I now really don't want to lose my one Bitcoin because it's worth $100,000 versus when it was worth 1,000, and perhaps that was less significant to me as an individual holder. So for me, it's the question of, how do we take these now greatly appreciated assets, make them productive at a rate that is interesting to the holder while not taking on too much exogenous or market risk? And so that's really where we spend our days and where we play.
Okay, give me the TLDR, the elevator pitch on Blueprint, just to set the table for other listeners.
We make predominantly blue chip assets highly productive in a way in which we don't take on too unusual a risk curve that you might traditionally see in DeFi or other digital asset managers. So we use a fully automated, built, heavily audited structure, one in the EVM space called Concrete, one in the Solana space called Glow. Those two are frameworks to very securely put your digital assets to work while getting sustainable above market rates of return comparatively to traditional finance.
Okay, and just to go back on that one last time. Concrete is ETH, Glow is Sol.
Pretty much.
Gotcha. Okay.
Yes.
So in doing research for the show, again, we have weekly crypto meetings, weekly meetings at Crypto News. I always bring up the podcast. I go, these are the guests I have on this week. Any good questions? A couple of folks asked, which I thought, okay, I get why ETH and why Sol. ETH still has the highest TVL. Solana is, I'm biased. I really enjoy Solana. I think it's great for new incumbents getting into the space. The DeFi opportunities, Jito, the whole 9 yards is awesome as well. How would you per se different yourselves from Jito, where it's like, if I am a user and I want to get yield on Sol, I can go Jito, Solstice, there's a bunch of opportunities. I can go Glow. It's like, what is the difference, and why does Glow under the Blueprint sort of parent company? What's that value prop there?
Yeah, I think there are a couple of things. We've seen the proliferation of kind of the vault thesis across both the EVM networks. We've yet to really see that proliferate within Solana. And you can think about our vault product in Solana becoming a way in which you can come to a single venue where the funds effectively remain and have further utility within the Glow functionality, but could be actually deployed and put to work in net new areas for rotation where there may be interesting farming opportunities and or consistent basis trades. So you can basically rest easy that under semi-active management, let's say, your funds are effectively being put to work where the best rate of return is currently available. Should you need to reposition, you don't actually need to do anything. So it's kind of a bit of, attractive rate of return on easy mode for most people participating in Glow on Solana right now.
Gotcha. So vaults, I'd love if you could do a deep dive on vaults. We've seen vaults take off on a lot of different chains, Hyperliquid being one of them as well. I'm big on vaults for the listeners at home, and Nic can do a much better job of explaining this than I can, and he will. But vaults are like money managers. Yes, you do have a person making some decision or teams making decisions behind the scenes. A lot of it is baked into the algo as well, but you're not paying the traditional whatever bullshit fee you have to give a money manager, and your return is also usually not as greater. Mind you, you're still getting a similar risk profile as well. It's sort of just like automated finance, right? Going from traditional stock trading, starting with your broker, them renting you $10 on every trade plus more fees, whereas with Robinhood, everything's free, and they're taking a very, very, very small percentage. I sort of give that analogy to my TradFi friends. Would you say that's sort of how vaults work? And if not, what did I miss there, Nic?
Yeah, no, I think it's a really good summary. Maybe going like one level deeper and maybe a slight hot take. I will say that from an architectural basis, the actual vault itself is probably the most uninteresting part of the entire experience. It's what you can do kind of above and below it that really makes a difference as to why you might pick a particular vault provider or yield optimization platform. So if we start on the slightly more execution side, which is behind, the vault is basically a vehicle that can receive digital assets and then through different execution frameworks, put them to work in a series of different strategies or venues or ways in which can return rate of return to the original depositor.
Gotcha.
So for us, one of the things we can do is we can apply small amounts of leverage. We can lend those funds out. We could, although we don't, take a directional bid on assets. So what we really specialize in is trying to remain as very, very close to delta neutral as possible.
Gotcha.
Within the digital asset ecosystem. So commonly will be about 0.004 to 0.006% directionally biased based on the strategies that we operate. And those are all fully automated.
Yeah.
On the kind of topography, the surface area, which I think is starting to become a really interesting area for institutions to start using the vault surface, is when you deposit the assets directly into the vault, you often receive a vault share or a vault token.
Yeah.
That vault token affords you the right to claim that asset back out, plus whatever is the rate of return that's been accrued over the duration you've been a depositor. There are lots of really interesting things I think we're going to discover over 2026 around the utility of those vault shares as novel forms of collateral, and also a way to defer a representation or recognition of the yield accrued over time, which for institutions can be really, really interesting for balance sheet management.
Interesting. Okay. Delta neutral. Again, I know we've explained this so many times, guys. Delta neutral is just like, let's say Nic and the team are $1 million long Bitcoin of what you've sold. They would be $1 million long SOL, $1 million short SOL at the same point using, and then they'd get that ARB from different exchanges, different trading venues, everything of the like, and then pass it back on to the user. So when you guys hear delta neutral, it's honestly that simple. Yes, there are some nuances behind it, as I'm sure Nic can go into in depth, but it's really just you're $10 million long one side of it, you are $10 million short the same asset, and you will often find ARB opportunities on different trading venues. You take that spread, you give it back to the vault, and like Nic said, there's vault tokens, vault coins, whole 9 yards, and you can do some novel finance things to move and groove and work some magic there. I do think the whole delta neutral space is still in the top of the first inning. Like in TradFi, the number of delta neutral funds out there are in the gazillions, whatever is above $1 trillion. And I think we're going to start seeing that in crypto as well. I also think when people sort of talk about why assets don't move as vicious as they used to, I think that's another reason, because there's less sort of people being gig along or giga short. I think a lot more smart money is now being delta neutral because of those sort of funding ARB opportunities.
100%. I do think it's worth calling out that one of the reasons that we haven't seen this proliferation yet in what we would call slightly more sophisticated or more consistent money management opportunities is it's a lot harder to execute a consistent near delta neutral strategy
100%.
in digital assets and traditional finance. And the other thing is, for a lot of folk who've been early on, the premise of making, high single digit or low double digit consistent returns on capital is much less interesting a couple of years ago than taking a punt on a meme coin or clicking on Rollbit or whatever it might be. So that That casino mimetic trend is hopefully drifting away from us. And I know it seems counterintuitive to a lot of us who've been in the space for a while, but we do want to see the volatility compress a little bit. That will entice a lot more durable, a lot more sticky liquidity to come into the space. And that means that a rising tide lifts all ships. And that's what we want to get it to in terms of adopting institutional flows. And we're not quite there. To your point about ETFs, great way to show interest in the space, great way to get generalized exposure to the space, but it doesn't really represent native flows on chain. And that's what we need to be able to deepen the books and allow more sophisticated actors to take part in size.
Yeah, well said. Nic's on a roll here, guys. We're going to take a quick break. Give a huge shout out to our sponsor of the show. Before we do that, one last thing, just to fortify Nic's point. Guys, don't go try some delta neutral ARB opportunity by yourself. Like he said, it's bloody friggin' difficult. And there's a bunch of really good teams like Nic's that are doing this. Give them an opportunity to do it for you. Just like anything else in life, if someone professional or someone 100 times better than you, a team 100 times better than you is going to give you access to their services for a very reasonable fee, I would probably do that. That's literally just business 101, supply and demand. So please do that and do not try to go delta neutral, because one, you need a shitload of money to make it work, and two, it's very difficult. So I'm just going to go and say it right now. Try not to do it. Huge shout out to Prime XBT, longtime friends and longtime sponsors of the Crypto News podcast. We love the team at Prime XBT as they offer a robust trading system for both beginners and professional traders. It doesn't matter if you're a rookie or a vet. You can easily design and customize your layouts and widgets to best fit your trading style. Prime XBT is also running an exclusive promo for listeners of the Crypto News podcast. Use the promo code CryptoNews50, that's CryptoNews50, all one word, to receive 50% of your deposit credited to your trading account. Again, that's CryptoNews50, all one word, to receive 50% of your deposit credited to your trading account. Okay, I want to get into one of your takes, which I love, which is your critique of chasing headline APY. You've been vocal about this. I absolutely love this. Again, for the listeners back home, APY is just the annual yield that you get on whatever trading or investment vehicle that someone is advertising or showcasing. We've seen some absolutely bonkers APYs. You always have sort of new ecosystems will come out with, 1,000% APY. Always ask yourself the question, if it's too good to be true, it's probably too good to be true. Why do you hate that so much? And why does real yield, in your words, require real mathematical rigor?
Yeah, I think it's a really, really critical point, and probably one of the biggest things that has held the industry back from being taken really seriously for a long time.
Completely agree. Completely agree.
I mean, you talk to your parents, you talk to anybody you know, and you say, oh, mom, dad, I'm getting 85% APY. And, love it or hate it, they've probably been, putting money to work through various traditional instruments like the IRA or any other kind of dividend or stock-based program for longer than you've probably been on the planet, right? And I'm not saying they're experts, but they know enough to say that no one's ever come to them with a straight face and promise them 85% APY, let alone something like 2,000%.
Yeah.
And so you've got to ask yourself, well, if this was so significantly performant, why isn't everybody on the street using it? Why are we still fighting for 1 million, daily active users in DeFi? Doesn't make a hell of a lot of sense. So you've really got to get down to the bare metal and say, where is that calculation coming from? And I think what we've seen a huge proclivity to happen over the better part of the last half a decade is projects not kind of incorrectly or malfeasantly reporting potential rates of return as real rates of return. And a lot of that comes from token incentives, which are not yet tokens, so promissory point systems and or airdrop opportunities that are marked at some hypothetical valuation. Very easy for me to suggest that something should be worth $10 billion at market cap. So I'm going to start giving you shavings off it and calculate that as an inferred rate of return.
Yep.
I think there are a lot of participants in the space who are getting a lot better and a lot more supportive of their users that know to kind of toggle on and off the effective rate versus the inferred.
Yep.
And you see a massive delta between those two things. You commonly see kind of 45% APY, and then you toggle off incentives and it drops to something much more reasonable, like 5 or 6. My argument is you can take a chances view on it and say, you know what, I'm happy with 5 or 6%, and I'll hope for the 40% when this becomes a real token or when that may come out.
Yep.
No problem with that, but we should make sure we know what we're getting ourselves into. Our view, though, is why don't we just give you a higher base rate, 7, 8, 10%, depending on what you're contributing to us. And we'll still get some, by default of operating on chain, some rate of return from various airdrops, points, or token incentive mechanisms. We don't necessarily calculate those as part of our rates of return, just because we don't think our users should be expecting something they don't receive. And I think that leaves a bit of a sour taste in a lot of users' mouths when it's like, hey, I thought I was getting 180% APY, and when I withdrew, I ended up with 3.
Under promise, over deliver.
That does not bring people back.
Yeah. Yeah. Under promise, over deliver. Great lines. Whoever, I mean, it's one of the best quotes of all time. Another thing that you've been very big on is sort of, the next frontier of DeFi. I know we talked a little bit about institutionalization a little bit. Credit, you've been big on capital inflows as well. We have credit, we have tokenization, we have new markets. Again, what you guys are doing is one of the sort of next parts of the new frontier of DeFi. It does evolve. It's wild. And I'm doing a shitty job of articulating this, so my apologies to everyone listening, but DeFi hasn't evolved that much since sort of the inception of crypto, but at the same time it has. And I feel like over the next couple of years, we're really, really, really going to level up and actually rival TradFi with not only the solutions and the opportunities, but also the trust. Because right now, that in my eyes, that's still the biggest difference. The two biggest differences are the liquidity, where you're not having that global liquidity, that institutional liquidity. That's number one for TradFi. Number two is trust, where there's just still way too many scams on crypto. There's still a shitty taste and disdain in people's mouths and minds and hearts. And these are going to change. But credit, tokenization, new markets, what are your sort of big thesis points, narratives for the next frontier of DeFi?
I think for me, it's what can we do with effectively a net new layer of activities, but also the ability to trade things like more coupon-like. So if you look at the derivatives market within traditional finance versus the pure equities market, there's many multiples the size of it.
Yeah.
Now, I think a lot of people will say, well, we've done rehypothecation to death in crypto. I would say that there are good ways to handle rehypothecation and generation of debt and credit within a system. And there are bad ways. And for better or worse, we took some of the bad ways in the early days of DeFi, and that blew up a few people's desks. Yeah. So for me, it's a question of how do we consistently create tokenized representations of debt structures, just in the same way that we sell paper forward, we sell mortgages, we trade insurance books, we reinsure products, we build paper financial markets in and around pure assets. We want to see that proliferation. However, the point here is, how do we get clarity on regulation? How do we get sophisticated actors and participants to create those products and then make them tradable and price them effectively? Now, a little bit of mispricing is obviously the area where you make money. If you think you're buying something that's undervalued or selling something that's overvalued, you're going to make a spread. But we have to put those mechanisms in, and we also need a regulatory framework around it sooner rather than later.
Damn good point. How do we do that though? That's the gazillion-dollar question. I mean, even just the pricing of the assets, I'm quite interested in the tokenization of everything right now. It's a lot easier to tokenize stocks and everything else that already have, price discovery and a price. But tokenizing, Trove just went live, or not live, but completed their ICO yesterday. Pokemon cards, Birkin bags, things that, I mean, it's really just word of mouth and a bit of data that can be very easily spewed. Like, no one knows the actual market value of these things. It's what does the market feel at that time. I think we're going to get into a lot of spooky stuff over the next couple of years with that. I do think 27, 28, we will finally hit legit product market fit when it comes to pricing those things. But how the heck do we do that? Do we need government regulation to come in? What is the proper way to make this work look like in your eyes?
If I'm completely honest, I think we're probably a little further out from all of that becoming mainstream. Now, the market for Birkins is massive.
Huge.
Right?
Yeah.
Eyes water when you see the prices on some of those things. But realistically, who is going to be the regulated body that ensures that when you buy 1/10 of a Birkin handbag and you seek to redeem that, what do you get, and who will be the affected issuer of the value of that to your other side? Or is some poor Birkin getting 10% chopped off of it? Are you getting one handle in the mail? There has to be some element of recourse and control around all of this. We don't have those frameworks at present. And there's certainly not right now, for me, a known counterparty who will buy that risk by default.
Yeah.
And so I think one of the biggest areas for expansion is probably in the insurance space, and selling that obligation on, transferring those financial risks to one another and paying a funding rate for that frees up a lot of capacity, a lot of depth, and you often find deeper pockets will sit behind an insurance book and enable those activities to continue to proliferate. You look back at the origination of insurance with Sir Lloyd doing insurance on ships that were going out to sail from harbor in the UK, TLDR. He had the cash to cover it, and he was willing to take the risk across a fleet of ships and was able to claim back huge value of that over time. But that encouraged a lot of people to get out to sea. And I think what we need to see is some way in which we can ensure more people to effectively push their boats out into the ocean.
Great analogy. Who's going to do that? You have any Lloyd's insurance guys on the phone? We do. That's actually what we need. I mean, that is the solution.
I think it's a really, really hard actuarial model to build. And because if it was easy, it would already be done.
Yeah.
There are a lot of people with deep pockets who could take a huge amount of the percentage of the aggregate market cap in crypto on as a protective instrument, just because of its absolute nature and size as a percentage of their books. The problem, however, is that we don't have good recourse. We don't have consistent, deep, high quality data streams over a long period of time. And the behaviors have been really erratic. So if we look back to the N of people that have participated in the market, pretty small. If we look at how do we create ethnography and typology around those customers, we by default have promoted the obfuscation of knowing who's on the other side of the trade, where does the money come from, who are they, what did they do, what does the rest of their financial history look like. All of these things that typically feed actuarial models. DeFi itself has been designed in part to remove those from that pricing activity in terms of understanding the risk and underwriting the challenges around the space. It's a really hard problem to solve. I think I always say, if anybody has solved it, please pick up the phone. I'd love to do business with you. But it's not an easy spot to spend your time in right now.
I love that. Just taking notes there. That is huge. I got to do a deep dive on insurance and crypto. I have yet to do that. Nic, this has been an absolute banger. Again, your episode's going to air in 3 days on the 15th. Any blueprint news, any concrete news, any glow news before we let you go today, or just any hot takes, anything you want to leave us with before we let you go?
Yeah, sure. I mean, looking forward, I think one of the biggest bastions and stores of value within the space are the prime brokerages and the qualified custodians. They've accrued massive balance sheet capital in the form of looking after other individuals' assets and trying to make them more and more productive. As I think we've seen staking rates decline, and we'll probably continue to see that happen over time, we will highly likely see a much more aggressive and faster moving space around those two types of institutions and getting their balance sheet capital to work in the most risk-adjusted way and very safe and transparent mechanisms. And without revealing too much, we'll be announcing a bunch of stuff in that space with a couple of groups over the coming months.
Nice. I love it. Where can everyone find Blueprint, Concrete, Glow, the whole 9 yards? Where can we find all of, I guess, sort of the Blueprint families, brothers and sisters, online and on socials, and of course yourself?
Sure. So please come and find us on concrete.xyz, glowfinance.xyz. We have the corresponding social links within the websites there. Please join our Discord, follow our X. And if you ever want to reach out to me, I am Nic, Nic, _builds @. So anytime you want to reach out, please grab me.
Great handle too. Folks, we're in an episode with Nic Roberts-Huntley, CEO and co-founder of Blueprint Finance. Absolute banger on everything about the next frontier of crypto and DeFi. His point about insurance absolutely blew my mind. I'm going to be doing some more research about that, and we may even need to find a crypto insurance guest to come on the show, although I really don't know of anyone either. So that point still has my head spinning. It is currently in a blender just going round and round, but that's why we have great guests on the show. Huge shout out to Nic and the team for making this happen. If you guys enjoyed this one, I hope you did. Please do subscribe. It would mean the world to my team and I. Speaking to the team, love you guys. Thank you so much for everything. Back to listeners, you guys are the best. Keep on growing those bags. Keep on staying healthy, wealthy, and happy, and we will see you on the next one. Love you guys. All the best. Ciao.